Today's Animal Spirits is brought to you by NASDAQ. NASDAQ sent us this Merlin AI survey of financial advisors, RIAs, brokers. This was an interesting one. What is your expectation for annualized equity returns for the next 3 years? Okay, so the options are 0%, 0% or less, 0 to 5%, 5 to 10, greater than 10.
I'll go 5 to 10.
65% said 5 to 10.
Feels right.
1 in
Who
5
went negative?
said
Who went negative? Show yourself.
2% of people. Greater than 10% was 12% of people, and then around 1 in 5 said 0 to 5%. I don't know. Yeah, I guess the starting point is kind of a big thing here because we're in the midst of a bear market. But it also makes sense that, I don't know, we had a really good 3 years prior to 2022. We had a really good 12 years, in fact, that, I don't know, a 0 to 5%. I think people should be happy with that.
If we
Even
got 0 to
including the
5?
bear market. I think so. I think people should be happy for that, for a little mean reversion.
Well, how about this? If we got 4% for stocks in the next 5 years, which would suck objectively, the 10-year returns would still be probably closer to 10.
Pretty good. Yes, you're right, because things have been so great. So if you want to learn more, go to NASDAQ.com or check out our show notes for a link to this survey.
Welcome to Animal Spirits with Michael and Ben. Ben, you just mentioned something. You just said it out loud that we're in a bear market. Now, listen, I know we're in a bear market, but it does feel a little weird to hear you say that. It's like, shit, we're in a bear market.
And we have been in one, I mean, technically for a couple of weeks, but realistically for a few months now. Probably.
We technically came out of the bear market. We poked our head above for a second. Now we're back down below. So we're recording this on Tuesday at 12:20 Eastern Standard Time.
The only time frame that matters.
Actually, every time is standard time, right? Everything is ST. But I feel like we all know that Eastern is, no offense, the real standard time.
Yes.
So the market opened up pretty positively and rolled over, which, listen, this is what happens in a bear market, right? You get higher lows. Okay, that's it. All right, okay. We got a K from Ben.
Here's the thing. Here's the thing about the market. So we had 2 down weeks of 5%. The last week was up, 5 or 6%. It does seem a little bit like everyone in the market during a bear market thinks it's game 7. So they think that the outcome is determined by like that day or that week, or the market is telling us this on this day. We're definitely going into recession. And then no, the market is telling us this on this day. We're definitely not going into recession. Now inflation has peaked and the Fed's going to put it seems like people want it to be like the end of something or the beginning of something.
I did see a lot of bear market rally calls on Monday. A bear market rally to 4,200 on the S&P. Did see a lot of those. Okay. Could still happen. So we're going to lean on Bespoke to start the show. They have this great chart showing the 10-year Treasury Yield, the 5-day rate of change for the last 5 years. We went from the largest 5-day increase to the largest 5-day decrease. So huge volatility in the interest rate market is not something you really ever want to see.
I guess maybe the biggest takeaway for a lot of people should be higher inflation or just macroeconomic environments that we haven't seen. Just increase the volatility in both the economy and the stock markets. That's not like a going out on a limb thing to say, but
yeah, you don't want to see volatility in the economy. By the way, Duncan's sliding into our Slack saying that it's Eastern Daylight Savings. It's EDT during daylight. Duncan, get out of here. We're recording.
All right. So last week we said, can the stock market sniff out inflation? And it seems like this week, everywhere you're seeing charts of commodities falling. And maybe that people are saying, well, the stock market rally last week was kind of sniffing that out. Is that a possibility, or do you think that these are just head fake moves?
I think it's possible. You're looking at base metals in a bear market, industrial metals like things like Freeport.
Why are they called base metals?
Because it's in the base, ace of base. I don't know.
The base of what?
The base, the base of the earth, the crust. I have no idea.
Building?
I don't know. You see cotton?
I'm asking questions.
You see cotton?
No, I don't follow the cotton markets. Sorry.
Cotton is crashing. Cotton is crashing. Lumber is down a lot. A lot of
so your Instagram t-shirts are going to be on sale.
A lot. I hope so. A lot of agricultural commodities are down a lot. Energy stocks. This chart from Mike Zaccardi. XLE fell 23% in the last 10 days. The last time we saw that over the last 20 years was October 2008, March 2020. So I don't know what's going on there, but there's just volatility all over the place. Liz Ann Saunders tweeted the percentage of commodities with a positive monthly return is the lowest it's been in quite some time. And if you look at like Freeport McMoran, Alcoa, these obviously highly sensitive cyclical
I would
commodity
love to
stocks are down a
see
lot.
from our ETF experts who listen to the show, if how much money has come in the last couple months into commodities, and if a lot of that ended up top ticking some of this fall. Now, a lot of it could just be these things had an amazing run, and now they're giving it back a little bit, and trend followers are getting out. But it's interesting to see commodities rolling over. As like, is this people just trying to get ahead of stuff because they think, well, demand hasn't fallen a ton yet, but because the Fed's raising rates, demand is going to fall. So we're going to sell off commodities. I just think the most interesting stuff about the market right now is people trying to front run everything, right? Trying to get ahead of stuff and guess what's going to happen next based on either what the Fed does or inflation does or interest rates do. I just think it's really interesting to see how much, because it seems like, I don't know, a lot of this stuff, almost all the big moves, you could say that there have been certain people who kind of called it in advance, but they just didn't know the timing or the magnitude of it. Like even something like as simple as interest rates. Forever we were talking about why is inflation so high and rates aren't moving, right? And whatever the reason was, a lot of people thought rates should be higher. And then when it finally happened, it just happened really, really fast. It seems like that's what's happening with a lot of these moves. The stuff that people think could happen or should happen, when it does happen, it moves fast, very fast.
One silver lining of this is that prices have come down a lot. Earnings have not yet. Earnings expectations certainly have not come down. So we have this chart from Urian Timmer looking at small caps. Russell 2000 fell 30%, 31% peak to trough. And the PE ratio of profitable companies only. I don't know how many companies in the Russell are unprofitable, but it's a lot. I don't know if it's a fifth or a third. It's a lot. So the PE ratio of profitable companies is under 10 for just the second time of the last decade. Looking at the forward PE, also telling the same story. Now, if earnings collapse, then the picture changes entirely. Obviously,
I'm sure this is basically a value ETF, but I'm surprised they don't have an ETF of profitable Russell 2000 companies.
Yeah,
right. That should be a screen. Right, make that happen.
So we got some weird dynamics in the market where all of a sudden you've got a lot of these gigantic mega cap tech stocks, Facebook, Netflix, all added to the Russell 1000 value. That's where we are.
So Wall Street Journal did an article on this. They said some like the notable additions to the Russell 1000 value: Facebook, Netflix, PayPal, Zoom, Moderna. And this is as of the time they published this. Meta was down 53% this year. Netflix down 70%, and PayPal down 61% this year. I mean, obviously some of these stocks are still in the Russell 1000 growth, but like I shared this with you and Josh the other day. So this is the PE of this. I think this is as of the end of May. S&P 500 price to earnings and price to cash flow is 20.3 and 15.7. For Facebook, I refuse to call it Meta, 11.8 and 11.1. Now, the second level thinking would be, well, Facebook's in trouble. They deserve to have a lower multiple because the company is screwing up or they're spending too much money or whatever it is. But Facebook is a value stock now, right?
Facebook is getting dinged because their user growth slowed dramatically. I think it might have gone negative last quarter. I can't remember exactly, but I think the market is punishing them because they're hemorrhaging money on the metaverse play, and the market's just not buying what they're selling. I'm not buying it either, but I might consider taking a position. Might consider it.
Catching a falling knife.
Well, I don't like to do that, but this would be more of an investment. I wouldn't trade this thing, but 9 times free cash flow yield. I mean, this thing is definitely as cheap as it's ever been as a publicly traded company.
So it sounds like a lot of the growth stocks are getting cheaper. So this is from Bespoke again. After a massive widening in late 2020 throughout 2021, the spread between the price to sales ratio of the Russell 1000 growth and value indices is now lower than it was pre-COVID. So it shot up to like almost 4 times Russell 1000 growth to value in terms of price to sales. Now it's back to where it was. So again, another complete round trip here. Are we going to get books about like the 2020 to 2021 period? I know we've gotten some like GameStop stuff, but that little boom there is, I know it happened. It was kind of flash in the pan. I think that you're going to look back and see a lot of those numbers from that time period are going to just totally stand out historically over almost any other period, right?
Yeah, this was weird times. Amazon's getting killed today. Apropos of nothing. All the high beta names getting rocked again.
I've been questioning my fellow Fed coworkers the last couple of weeks here. Jerome Powell was in front of the Senate Economic whatever committee last week. I don't know what it is. First question Elizabeth Warren asked him, she said, will rate hikes bring down gas prices? He said, I would not think so, no. Will rate hikes bring down food prices? I wouldn't say so, no. So my question is, why is the Fed pushing so hard if the biggest problems they can't really solve?
I think they have to do something. I think that they're making up for maybe missing the not transitory nature of inflation. They don't want to get fooled. Fool me once, shame on you.
I mean, they asked him, could you push us into recession? He said, I wouldn't rule it out. It just seems like if the Fed does push us into a recession, it seems like it's an avoidable risk because a lot of the problems are stuff, again, that they just can't solve and that they're going to make it worse on other areas to make up for those problems that they personally can't solve. I guess I just don't understand that line of thinking. The Wall Street Journal had a piece from, I guess he's Finance Woj now, right?
Nick T?
Yeah. Nick T at the Wall Street Journal talked about how the Fed missed this. And they talked about one of the big things is that they were fighting the last war. So this chart is amazing. The employment of 25 to 54-year-olds, which is prime working age. And it's showing the 1990, 2007, 2020, and then 2000 recessions. And you can see all these other recessions took a long time to get back to the prior place. So 2007 took over 12 years to get that employment ratio back to where it was from before. That's a really long time. Wow. The Fed did not want to do that again. Now it's almost back there. So it says they were motivated by the lessons of the last expansion. It took 6 years for the jobless rate to fall from 10 to 5%. Obviously, it's way lower this time. Look at this percentage change in consumer spending. Goods and services. So services is still a little bit lower. Good spending is still way, way higher than trend. We've talked about this. So I guess maybe the overreaction is happening now, but what happens in the next recession?
To what?
Like,
the unemployment rate?
Well, is the next one going to take a lot longer to come back then? Is that like, or are they going to do that on purpose?
Well, I guess the question is,
say we're not.
All those job openings, we have like record job openings, 11 million or something like that. Does that does that just get pulled? Like, how quickly does that correct?
I don't know. So last week that's a really good question. Last week we talked about how high could the unemployment rate go in every recession, and I kind of ballparked it on the show. We had a research analyst, Sean, look at this for us. So the average low for before a recession is around 4%, and then where it goes to on average after a recession happens is around 8.5%. So you essentially get a doubling of the unemployment rate basically during every recession. If you just eyeball this chart, it more or less doubles every time. So 3.6 to 7, call it a little over 7 would be average, and the Fed wants maybe 5. So I guess the problem is, once you get to 5, how do you stop and overshoot on that type of thing? Of people, that's, I think, the hard problem.
Well, I'll tell you how. All right. You cut rates.
So did you listen to the Derek Thompson Plain English pod today with Connor Sen?
Did not.
It was a good zag pod. Basically saying everyone, quote, everyone thinks we're either in a recession or going there. And
I would put myself in that camp.
Connor Sen made some points saying it's crazy to think we're in a recession now, and the consumer is in such good shape, it's hard to see us going into a recession anytime soon, which was interesting. Now, look at this one. This is our old friend Walter Bloomberg, who I still don't think is a real person, right? U.S. screened 2.45 million air passengers on Friday, highest number since February 2020. Then 2 days later, we just hit another record on Sunday, 2.46 million at airports. The crazy thing is, business travel is down 30% since from pre-pandemic levels. Mm-hmm. That means, so I think we're still like 5 or 10% below where we were pre-pandemic, but it's getting close. The airports are basically back to where they were, a little lower. But they're doing that with 30% less business travel.
That's crazy.
Meaning this is more individuals traveling and spending. This I don't see how you could have so many people traveling and spending money, because I know when people go on vacation, they spend a lot of money. This doesn't sound like a recession to me. You could say this is the last gasp and then comes the recession, but this doesn't feel like a recession. All these people traveling and spending money.
Okay, I agree. Yeah, listen, I'm definitely open-minded to the idea that we've been talking about this for a long time, that the consumer has never been better prepared to enter a recession. But depending on how long a recession goes on, if we do get one, eventually all of the savings and the spending, all the savings will be depleted and the spending will dry up. That's what happens in a recession. So I think it's very fair to say that, yeah, we're probably not in a recession today, but what's the problem? Let's hear it.
So the consumer spending makes up 70% of the economy, right? Mm-hmm. If the consumer continues to spend, even with inflation being higher, doesn't that kind of push up recession off if people just keep spending?
Correct.
That's like the tug of war right now. Like, it seems like people should be stopping spending. They're not. Here's another one about investing is hard. Look at the Jets ETF. So airlines are booked beyond capacity, and they keep having to cancel flights. The Jets ETF is still down 40% from 2021.
Yeah, this one's interesting to me. I guess I would say the pushback is, somebody tweeted the number of passengers flying is down 10%. So we're basically, we've made back 90% of what it was, even with business travel down 30%. But the number of planes flying is down 15 to 20%. So planes are
because they jettisoned a bunch of them during the pandemic when they thought people were going to stop flying.
And I guess it's a combination of workers not coming back and maybe bad weather, and so. But anyway,
it's just crazy that airlines are busier than ever, or in the last few years. Prices are higher than ever because all the inflation is coming for a lot of the inflation right now is coming from airfares.
Maybe what are energy prices doing to margins? Number one.
True. I think that's part of it. I think it's just a crappy business, unfortunately.
And maybe investors are looking past the current environment of people just flying and traveling, and they're looking forward to airlines are pricing in a recession like every other area of the market. Now, listen, I think we've been saying this. If we don't go into a recession and the market is wrong, then stocks look incredibly attractive.
Pretty much. Yeah, it's just one of those things where looking at the headline numbers makes it a lot. It feels like 2020 was the year where if you just invested on headlines, you probably made a lot of money. And that's not the case anymore, where you can say the headline says this, so invest based this way. Here's another one for your consumer thing. This is from Wall Street Journal. End of the first quarter, U.S. households held $17.9 trillion in cash and cash equivalents, up a bit from the fourth quarter, much higher than the $13.7 they had at the beginning of the end of the first quarter of 2020. Indeed, before the pandemic, U.S. households never experienced anything like the increase in cash they've experienced over the past 2 years. This remains true even after adjusting for the run-up in inflation. And if you look at this chart, it's straight up. And here's a crazy one. So you think, well, that's all just wealthy people hoarding cash because the rich got richer. People in the top 10% by wealth had 32% more cash in the first quarter from 2 years earlier. People in the bottom half held 45% more. This is across the board. Mm-hmm. People of all income and wealth levels now hold more cash. Again, they're ready for a potential recession more than ever before. And if people are ready and can still spend, you're right. Eventually all that excess cash gets sucked out, but it's so much higher than it was before. Like, things were pretty good in 2019. People have way more cash, way less debt, way more wealth than they did back
I just think it's a matter.
Obviously,
I think it's a matter of inflation, right? Like, if we get $5.50 in gas as a national average, like, at some point, all these price increases are going to hit the consumer.
I do think that a lot of the economic data, because again, we're treating everything like a game 7. Every stock market day and every economic data point is game 7. This means this, and that now that can't happen anymore. Isn't it possible we just have a lot of back and forth in like the coming months?
Yeah.
Where this looks like an imminent recession from that data point. But wait, this data point says there's no way we're in a recession right now, and we just go back and forth, and it chops you up and makes you think, okay, I know what's going to happen now based on this.
For sure, that's a good take.
And then we just don't know. All right. So a lot of the stuff we saw in 2020, early 2021 was, if you would have just invested $10,000 in this, right, you'd be on easy street, you'd be making millions of dollars.
We should flip that. If you shorted $10,000 worth.
I think it's fair to look at the other side. So I'm saying it's okay to look at the other side. So this is from the newcomer, from Eric Newcomer. He's got a Substack talking about how Sequoia is down bad. He said at current share prices, Sequoia's positions so they're talking about Unity and DoorDash were two of Sequoia's biggest positions that they took from private markets to public markets. Together, they're worth like $4.2 billion. It says if they had sold their current holdings near the all-time highs, they would have generated $18 billion in returns. Or more conservatively, if it had just sold a year after they went public, they would have generated $12 billion in returns. They own like 24% and 20% of these stocks, and they're down 80 and 75%. I think it's okay to look at this the other way and saying, instead of the people, look at how rich you would have been if you would have just done this, to man, now looking up at the peak going, can you imagine how much money we left on the table? There's a lot of that going on right now, especially in the tech world of, oh man, if we would have just sold, can you imagine? Mm-hmm. So there's a lot of people who went from insanely rich to now only maybe a little rich.
Speaking of DoorDash, on Friday night, I went to the movie theater. We'll get to that later. And Robin...
By yourself?
Of course. It was date night.
Yeah.
Robin texted me, oh my God, that was expensive. So I get an alert on my phone. Or not an alert. When I have Seamless connected to my phone, right? So I get like in my inbox, like when we order stuff. All right, here it is. 1 medium Greek salad. By the way I just said that reminded me of the scene in Austin Powers. 1 Swedish penis enlarger. All right, 1 medium Greek salad with extra feta cheese. My wife is a feta lover. And chicken.
Okay.
And tzatziki on the side. That was $25, which in and of itself makes me want to punch something.
Okay. Not a New York guy. I'm a flyover state guy. What's tzatziki?
Tzatziki. That's how I pronounce it. It's the white.
I can't say.
It's the white sauce.
There's a lot of Z's.
It's the white sauce. You know what? You don't have Greek food in Michigan?
I'm just not a Greek food guy.
Really?
I'm sure we do.
What don't you like about it? You don't like falafel? This is a revelation.
Yeah,
gyro meat, kebab.
I guess I just don't get it very often. Yeah, I probably would like the meat.
Okay.
Yeah, I guess we probably just don't have a lot of Greek food.
All right, Greek food is a staple in my household. All right, so that's $25 for a medium salad with chicken and some feta cheese and a side of white sauce. The delivery fee was $2.50. The service fee was $2.50. The sales tax was $2.50, and the tip was $6. This was $40 freaking dollars. $40 for a salad with chicken. And I forget who wrote about this, maybe Allison Schrager, that everything was artificially cheap because the investors were subsidizing our lifestyle. And I think Derek wrote about this too. That's over. And we knew if DoorDash couldn't make money in recession, how are they ever going to make money? And so now you've got fees on top of fees on top of fees. Artificially low prices are now rising. And so it's like, damn if they do, damn if they don't. They couldn't make money charging too little. This is definitely going to cause demand destruction. I'm not ordering 40. Robin goes, what should I have done? I was like, I don't know, make eggs. I'm never doing this. No freaking way.
Yeah,
I'm out on DoorDash and Seamless and whatever. I'm all out.
But do you think there's a lot of people who are just got used to the comfort of it and decided, it's a lot of money, but I don't care. I'm paying for comfort and convenience.
No, I'm done. Okay. I'm done with.
I would like to know what the difference between the service fee and the delivery fee.
Yeah, what the heck?
Let's just do. Yeah, it's a lot. So Matt Klein wrote about this on the Overshoot about like a lot of people complain about inflation, but it's like what exactly should we do? And he talked about this idea for energy prices, which I thought was really interesting. Like energy is such a cyclical industry. And they always say the cure for high prices is high prices, the cure for low prices is low prices, and we just have all these different cyclical.
Yeah, we've got Duncan and Sean at the peanut gallery over here. Duncan's saying, tzatziki is a dip, soup, or sauce found in the cuisines of Southeast Europe and Middle East.
Okay. that sounds like a Wikipedia entry to me. He Googled
Big
it.
tzatziki guy.
Okay. So Matt Klein is basing this off of a paper written by Skanda Amaranth, who made the rounds on the podcast. He was on Odd Lots and Plain English last week, talking about to make these businesses have more capacity and make sure that they don't pull back when we need it the most for, energy capacity. The government can just give them a price of like do futures contracts basically, where they're saying we will buy barrels of oil at today's prices. So you out into the future, 6 months into the future, whatever, 3 months into the future. So you don't have to worry about what the prices will be then. The government will buy them. They will guarantee the prices today. And that way you don't have to worry about hedging this stuff. I thought it was a really interesting idea as a way to solve this because it doesn't seem like there's many solutions being put forth by the government. I like the idea of thinking outside the box a little bit like this.
At first blush, I'm sure.
It makes sense.
All right.
Like I think a lot of this stuff people have been talking about is our supply chains are reliant on these other countries and these other producers, and why don't we like try to smooth out the cycles a little bit? It makes a lot of sense to me. All right, we've got some questions lately on inflation hedges, tips specifically lately. So I looked at this. TIP is the Treasury Inflation Protected Securities ETF.
Just the TIP.
It was up. Not nice. It was up 8% in 2019, 11% in 2020, 6% in 2021. Now, 2021 is the outlier there because bonds got killed in 2021. This year, it's down like 8% in 2022. People are saying, how could inflation be up and tips be down?
Look at interest rates.
So over the last year, that's the thing. So it's up. Inflation is up 8%, but over the last year, but TIP is down 4%. So Adam Collins wrote a good piece on this. He changed his blog. It's called Eversight Wealth. He has our tips broken. He basically said that rising interest rates have hurt more than inflation. And the other part is a couple of years ago, tips yields were negative, right? Meaning you only got the inflation component, right? So he was saying a 5-year tips bought today will return future inflation plus 0.5% per year compared to last June's inflation yield of minus 1.6% per year. So you're getting dinged on that in the past. And the thing is, these tips take into account the break-even inflation rate that people are expecting. And so the reason they did so well in 2021 is because it was unexpected inflation, right? Now in 2022, the inflation isn't expected, so it'd have to go even higher for the tips to give you.
So a lot of it was baked in.
A bigger bang for your buck.
A lot of it was baked in, and rates were rising. You okay over there?
Yeah,
you had a sniffle. It's pronounced. Allergies?
Oh, yeah. I think I do got some allergies.
Okay.
Sorry.
It's okay.
A lot of pollen around here. Anything else I'm doing wrong today? The mic, the sniffles. Jeez.
Listen, you muted yourself. That's not on me.
All right. So his point is like maybe it makes more sense to go short-term tips. So those because if you go in that TIP fund, that's a long duration asset. So the rising rates are going to probably hurt you more than the inflation is going to help. He was saying probably stick more towards the shorter term ones because the yield changes and it's more correlated to inflation.
We'll link to that in the show notes. Ben, what's your biggest personal money pet peeve?
Okay. So was it Saturday night? You sent me a text saying that your wife wouldn't let you wear a Tropical Brothers shirt again.
Was that outrageous? I had to stand my ground.
And did you wear it?
Of course I did.
Okay, good for you. I was wearing one as well because we were getting ready for.
Listen, we literally were going to dinner on the beach. I said, if not now, when? She was like, never. I said, yes. Nope, now.
So we went to a little tiki party, neighborhood tiki party thing, and a lot of people there. And I didn't know, frankly, a lot of people. It's a pretty big party, kind of like a block party type of deal. And people are sort of talking and, hey, did you meet so-and-so who lives over there? No, I've never met them. Oh boy, that they really like to brag about money. And they're talking about how much this house costs that they own and how much this boat they own costs and that other house is worth this much. You and I talk about money a lot. But I think one of my biggest turnoffs again, like talking to other people, is people who actually brag about how much money they have. I cannot stand that. That to me is like, I'm out immediately. Someone who like the first time you meet them is bragging about how much money they have.
Insta out.
Or how much stuff they
Insta
right?
out. But give me more context because I've never been in that position. At least not that I can remember where somebody's like overtly bragging about money. Like, how would that even work? Because nobody's gonna say this is how much money I make so much. I'm interested. What do you mean?
Okay, I mean, people these days talk about how much like housing prices are going up and stuff, and you don't have to even say numbers to mention it.
Oh, you could like sneak it in there.
But also saying, the huge boat I bought costs 4 times as much as my house, or that type of thing. Right. And it's like, really? Yeah. So anyway, that's pretty big money.
Oh, so here's like a humble brag or not a flex. It now costs me $1,300 to fill up the boat. That type of thing.
Yes. Right, there you go. Right, that's a good one.
Right. Thank you.
Yeah. Yes. That's a humble brag. Okay. Real estate prices. Redfin looked at where we're getting the most price decreases from sellers.
This has to be tech spillover. like Montana, Idaho.
I think a lot. Here's a crazy one though. Look at all the way down that list. Probably number 20.
Ooh, Grand Rapids.
They looked at Grand Rapids. So they looked at the sales price increase from 2020 to 2022, and then percentage of houses now with a price cut. And it's all these huge. It's at the top is Denver and Salt Lake City and Boise and all these places we've talked about. Portland, Grand Rapids is actually on there, but they showed all the places with a huge run up are now having the most price cuts, which makes sense because eventually you probably get in kind of like trading in stocks. You get an exhaustion of buyers, right? After a certain point, there's no one else to sell to, and the people who are trying to sell have to lower their prices.
Mm-hmm. Hey, look at this next.
Look at this.
Look at this next chart. This surprised me, but yeah. Speaking of price cuts, what was the number? I saw a number recently about the price cuts keep rising. Where is it? I can't remember. Anyway, year-over-year transactions are dropping, fell 13.6%. So I think that you're going to see way more transactions. The number of transactions is going to go down a lot more than prices, in my opinion. But this chart surprised me. We kept saying that it's not like this was speculation. It's not like it was like home flippers. This guy, Lance Lambert, who works for Fortune magazine, tweeted, "Frenzy and FOMO to a degree did return to the U.S. housing market." So this chart that we're looking at shows the home flipping rate as a percentage of total sales. And according to this, it was 10%, which is higher than it was during the housing peak. I find this number's hard to believe.
Yeah, I've never seen this before either.
I feel like if this was accurate, it would be a bigger story. I want to dig more into this.
I wonder if a lot of this is people who bought second homes. Because there was a lot of second home purchases being made but a flip would mean that you bought it then sold it, right? Yeah, that's higher than I would have thought. Okay. All right. This is interesting. The psychology of price cuts. So Rick Palacios always has a lot of good stats on Twitter about the housing market. More common for new home prices to drop than resale. This is from 1965 to today. So he's got this chart showing that builders meet the market faster on price versus typical owner, especially in recessions. So he's showing that basically it's quicker for new home prices to fall than it is for people who hold them. And that's kind of like the Richard Thaler endowment effect, right? You own a home, you think it is worth more. So I think there's some psychology behind existing homes versus new homes.
But also new homes have to sell, right? They got to sell. Whatever the market is, they got to sell.
I do think that's one of the other things that people don't put enough stock in for there continuing to be some housing transactions is someone who's buying probably, it's not all first-time home buyers. A lot of people who are buying are also people who are selling. And it's kind of a chain link of, right? It's like a chain reaction of transactions, right? Where someone's selling their current home for more than they bought it for, and they're also buying. And so that piece of it, it's way harder for first-time home buyers now. But I think that's the kind of thing that keeps happening. People who already own existing homes, it'll be tough to take a 6% mortgage on, but it'll make sense. And I'm wondering, do you think if, like, say next year in 2024, we go back to 5% mortgage rates, if people will be cheering that because it's better than 6%? Do we start anchoring to the higher levels now?
Good question. Could be. We spoke about layoffs coming in the real estate market. Primarily, you would think like mortgage brokers, all the refinancings are done. JP Morgan is laying off 1,000 employees in its mortgage division. So this is definitely not going to be the last we hear of this.
It makes sense. That's I think how this current whatever slowdown period you want to call it for the economy, if you're in a certain sector of the market, if you're in tech or you're in one of these loan departments, it feels like a recession to you. It just doesn't feel like a recession in other parts of the economy.
All right. Bad quarter guys, great quarter guys, mixed quarter guys. I listened to a few calls this week. I listened to KB Homes, I listened to Lennar, and I listened to Nike. All right, this was an interesting dichotomy.
Hey, you ever heard anyone pronounce it Nike before?
No.
I guess there's still people who call it Nike.
No, there's not.
I swear to God.
No.
Okay.
I've never heard that in my life.
Continue.
Name names.
Nike?
Name names. Is it a family member? Who calls it Nike?
No, not. I heard it on another podcast recently. The other host called the guy out. It was a comedy podcast.
You know what I heard on a podcast recently? FinTech Frank had an analyst who was talking about why Coinbase is undervalued. He kept calling it EBITDA. You ever hear that one?
No.
You ever hear that one? So I'm listening and I press pause and I sent Frank a DM. I'm like, what is this? I've never heard that before. He goes, just wait. So the guy kept saying it.
I think I put it up
he
on
kept saying EBITDA.
There was an old. I rewatched Sopranos and I put it on, and Paulie Walnut's talking about EBITDA, and he called. I think he called it EBITDA or something like that. There goes a good Sopranos one on that.
All right. Anyway, it was very interesting to listen to KB Homes. You wouldn't really know anything was up with the housing market, but Lennar like led off with like, listen, things are changed. Mortgage rates have doubled. Like, it was just a very interesting juxtaposition. So what we took out of the KB Homes one that was interesting was loan to value ratios held steady at 85%, translating to an average cash down payment of roughly $75,000. I thought that was interesting. It's a lot of money. $75,000 average down payment, and close to 100% of buyers use fixed rate products. I think both companies said on the call that they're not seeing people switch to ARMs yet, which is also, I think, notable. The average household income of these buyers was about $125,000, and their FICO score showed improvement to 734.
Don't you think that a lot of these home builders are just high end now? If their average income is $125,000, $75,000 down payment, high credit score,
the home buyer is strong.
The ability to buy a home is just moving up and up and up, and it's harder for someone on the lower income scale to buy a new home now. I think that they've probably just stopped building entry level houses in a lot of cases.
All right, we know these numbers, but it's still shocking to hear it. In the second quarter, our average selling price of homes delivered increased to $494,000 from $410,000 in the prior year period.
Jeez.
They said average selling prices were higher in each of our 4 regions, with year-over-year increases ranging from 18% in the Southwest to 23% in the Southeast. And they believe their average selling price for the full year will be $500,000. Oh, here it is.
I would love to see them. I would love to see the margins of this, because obviously for a while there, the costs were rising, and now I think that stuff is coming down and supply chains are easing a little bit. I'd love to know how much these home builders are keeping in margin.
So they're talking.
I'm guessing.
Well, I have it right here. We'll get to that in a sec. But they said they're talking about ARMs, and the quote is, it is already out there for the customer if that's what they wanted, and they're not moving there yet either. Talking about the ARMs. So look at these charts I have, Ben. Look at lumber. Lumber ran up, crashed, ran up, and crashed again. I would love to hear that guy back on with Joe and Tracy. I forget his name. I'm drawing a blank on his name. The lumber guy.
Oh, Stinson Dean.
Yeah, he's great. But look at these margins. I'm looking at gross and profit margins for KB Home. Lennar looks similar. So gross margins, profit margins have never been higher. Pre-tax income has never been higher. These stocks are getting murdered.
So if you look at it since 2019, that's an up and to the right for gross and for their profit margins.
And
right?
Look at the next chart. Look at the pre-tax income on a quarterly basis. Hockey,
these stocks getting
like
killed.
just vertical, and the stocks getting killed. So again, stocks are pricing in a recession, right?
It does feel like that.
Or these stocks in particular are pricing a severe slowdown in the housing market, right? So they're not getting credit for what they've done. They're getting killed for what might happen. So the market might be.
So maybe if we get this choppy scenario of good economic data, bad economic data, and we go back and forth a little bit, maybe a lot of the biggest movement is going to be in some of these sectors where the market got ahead of itself. Like if we get some encouraging inflation data that's coming in, and consumer spending remains strong, and maybe mortgage rates come in a little bit, then home builder stocks could rip while the rest of the market doesn't. Could be much. That kind of thing where we could see certain sectors move.
So they said the house. So now switching over to Lennar. Again, a very interesting juxtaposition of the two of them, just very different tonally on the call. So on Lennar, they said the weakening has continued to the third quarter. The housing market has cooled as expected in response to the Fed's aggressive and rapid reaction to inflation. The resulting very rapid, almost doubling of the 30-year fixed rate mortgage in 6 months has had the desired effect of slowing price appreciation and moderating demand by increasing monthly payment costs and reducing affordability. Of course, we know all of that. Then they went on to say that these changes accelerated during the quarter, with many marking the most pronounced impacts. And they're saying that in June, new orders, traffic, sales incentives, and cancellations have worsened in many of our markets due to rapid spike in. So it's just, again, it's very funny to see them handle things differently. All right, switch over to Nike. All right, take a guess. How much revenue does the Jordan brand do on an annual basis?
Like as a percentage or total?
Just total revenue.
$3 or $4 billion.
Very close. 5.
Okay.
It's not wild.
It's a lot of money.
Just the Jordan brand. So they said, to your point about the consumer being okay, the CFO said, we continue to closely monitor consumer behavior, and we're not seeing any signs of pullback at this point in time.
Probably not seeing a lot of sales from them yet either. Right? You're a sneakerhead, kind of. You still buying Nikes?
I'm pulling back. Listen, I'm tightening the belts. Recession's coming.
How many pairs of Jordans you got over there?
I haven't bought a pair of sneakers in a while. Actually, I'm an on-cloud guy now.
Oh, that's right. You've entered the dad level of sneakers. You go for comfort now.
Look at this chart from the Science of Hitting. Nike annual revenues. I mean, I know the stock hasn't been great, but this is why you own stocks.
How did their revenue grow in 2008 and 2009? That's unbelievable, right? They had no drop off in 2008.
I guess people don't stop buying Nikes.
Okay, I'm not sure what to say about ARK anymore. So this is Eric Balchunas. ARK took in $370 million last week, top 1% among all ETFs, and it's seen inflows in 8 out of the last 11 weeks. Year to date, it's now up a total of $1.9 billion, top 3% among ETFs. Still down 50% on the year, even after an 18% bounce in the last week or so. Money just keeps pouring into this. Is he the greatest marketer of all time?
It's incredible. Yeah, I mean...
No, I mean... The thing is, I guess retail investors are damned if they do, damned if they don't. On the one hand, people would say, all the money rushed into the top, and then it's going to rush out at the bottom.
It's not rushing out.
On the other hand, people say, well, actually, it's going in, but it's just throwing good money after bad. But I almost have to applaud the discipline. I don't know if it's going to work out, but the fact that people are still giving money to her, it's not what you would expect based on the history of people trying to time the market.
No, it is not.
I don't even know what to say anymore. All right, I got this email from Robinhood. Margin interest rates have changed. They increased margin rate from 3.5 to 4.25%, and they also moved from a fixed rate to a floating rate. So they used to just put it at a fixed rate and they kept it there. They're talking about how they're going to float it to Fed funds rate, which I guess with rates going up, that's probably good for them. But that's a little bit of a bigger hurdle right now. I think it was, 2% or something at the lows, 2.5% maybe for margin.
For sure, it matters. For sure.
That's got to sting a little bit if you're on a bunch of margin, right?
Yes.
And your portfolio is already down 50 or 60%. All right. Do you think FTX is going to buy Robinhood?
Yeah.
You do think so?
I do.
Okay, so Bloomberg reported it. I mean, Robinhood's down from a high of $60 billion to like a little less than $8 billion in market cap. Obviously, that $60 billion was a meme stock high thing. But even from there were, 30 or 40 billion for a while. Sam Bankman-Fried told Axios there are no active conversations with Robinhood. And they said, although that statement obviously doesn't preclude FTX from beginning talks at any moment. Can he do that? I mean, I know he's a billionaire, so billionaires can do whatever they want these days, but he personally bought a stake in Robinhood, right? That was his personal money. Can his company buy Robinhood if he took a personal stake in it?
Yeah, this is
that illegal?
This is a little WeWork, I don't know.
So FTX buys Robinhood. They potentially buy BlockFi, which we're going to get into in a little bit. Is Coinbase AOL at that point?
I don't think so.
Could FTX
I suspect that there is massive inertia in this market. I don't think everybody, put it that way. I don't think everybody will leave Coinbase and go to FTX. First of all,
what's the FTX valuation?
Well, in real life or as of their last raise? Was it 40 billion? Did they raise 420 million? I can't remember.
Yeah, they raised $400 million at a $32 billion valuation.
Okay.
Obviously, you're talking about, what is it in real life? It would obviously be a lot lower than that. How can they afford to buy Robinhood for $8 billion? That's the thing I can't understand. And if you're the Robinhood founder and you sell after your stock's down 80%, that's not a very good outcome for you, is it? Unless you really, really have to sell and you see no other out.
The enterprise value is only $4 billion.
Okay, because they have cash.
So,
so you think FTX is going to do it?
I do. So there was was it the Senate committee hearing on Robinhood? There was some report that came out. I honestly don't know the details, so forgive me if I'm misreporting this. But they did a deep dive into what went on, and Matt Levine just chef kissed the shit out of this. He said a Robinhood product manager emailed this. So looking at like GameStop Mania, which was was March 21, February 21. FYI, massive spike in Robinhood account openings in the last 30 minutes, likely caused by Elon Musk's tweet. And we could probably interact with this movement to promote Robinhood growth. You know what the tweet was?
Was it Dogecoin?
No, it was GameStonk. Remember when he tweeted that? So the here's product manager.
People opened new Robinhood accounts based on a tweet by Elon Musk.
Literally, that's where we were.
It really was the stupidest bull market ever. It really was.
So the product manager sent the message, conflict brewing. We have to keep the growth flywheel running. Webull is right on our tail. Head of data science. Don't worry. We need to survive first. So what happened was, let me just quote Matt Levine. He said, as Robinhood employees work through January 27th, to code position limits for meme stocks, they struggle with how to frame the trading restrictions to the public. Remember how they bungled the shit out of this messaging? Right? It was just horrible. And they seem to want to avoid giving their own clients the real reasons for imposing restrictions. A product manager at Robinhood Financial asked, do we have a customer-facing rationale we can provide? In response, a manager in Robinhood's brokerage responded, quote, the real reason is firm risk and us needing to control the velocity of trading, but we shouldn't expose that. So Matt Levine said the meme stock craze was so good for Robinhood that 430,000 people tried to sign up for its service overnight, and so bad for Robinhood that it had to ignore all of them. So basically, they had to post $3 billion, which they ended up raising in the private markets. I think you remember that. They literally were on the brink of insolvency. How crazy is that? During their best month ever, they literally almost went out of business.
Do you think that in some ways, like, financial literacy is just beating your head against the wall? If a tweet from Elon Musk and a stupid meme stock thing can get 430,000 people to sign up for a brokerage account, are most people just a lost cause at this point? And you help who you can help. Sometimes I worry that the majority of people are. If that's what gets you off the sideline to invest and put your money in the stock market.
Remember at one point,
I think I weep for humanity.
I don't know if it was Vlad or somebody at Robinhood said that our customers do not day trade their investors. Okay. Well, anyway, in the first quarter of 2020, Robinhood users traded 9 times as many shares as E-Trade customers and 40 times as many shares as Schwab customers per dollar in the average account. Here's another one. Citadel Securities employees estimated that the payment for order flow rebates it owed Robinhood for GameStop the week of January 20th, 2021 were approximately 60 times greater than the week before.
Jeez.
I think they made $150 million from Dogecoin. What a scene. What a scene. All right, let's talk.
So
yeah, go ahead.
If I'm FTX, I'm buying them at a discount, not a premium. At this point, right?
Oh, like a take under? Take under? Does that's not going to happen. Also, by the way, Vlad and what's his co-founder's name? I don't want to bungle it, so I'm just not going to try.
All right.
They own, I think, isn't it a dual class share class? I think they control the company.
Okay.
All right. Lots of smoke in the crypto markets, particularly surrounding BlockFi. And we're going to have Zach on next week, and we're gonna ask some hard-hitting questions. So I'm excited to have him on the show. The public news is that FTX there's a $250 million line of credit that FTX has out. And the smoke is that this CoinDesk is reporting this. It stood to wipe out BlockFi shareholders. So now there's rumors that Mark Yusko's Morgan Creek is trying to put together an alternative packaging, but the smoke that we want some clarity on is that this was the only deal that they could get where the equity holders were wiped out and the customer deposits accounts are safe, which, by the way, is, if this is true, is obviously the way that it should work. You don't wipe out customer deposits to save the equity shareholders. Hello?
All right.
You're taking risk. You got the upside. You take all the downside. Customer deposits, And so what I want to know is there's all sorts of rumors about the number of accounts, like a percentage of accounts that were pulled off the platform. Obviously, we don't know.
Right, meaning people that left. Right. The crazy thing is about this. So BlockFi never stopped paying interest. So they were still paying interest.
They never gated, and they never gated. They never gated withdrawals. So if you wanted your money, you got it back.
I think I mean, in a way, this feels like the early 1900s bank runs. Like, you read this one, right? The Panic of 1907.
Yes.
You read that book?
Yes.
Like, this crypto run feels like that, where it's so early. In a lot of ways, crypto was a victim of its own success because it feel like it pulled forward too much. But my only takeaway from this whole thing is, like, there was just way too much leverage in the system. And I think even if you have the most stringent collateralization rules and lending protocols, which it sounds like BlockFi did in some ways, and maybe the stuff with the hedge fund one was the one that possibly did them in, but even if you still manage to meet all of your obligations, if the price of your underlying asset that you're lending against falls 70%, you can't really stop a run in the bank, and there's nothing you can do about it. And if your customers leave and there's no more demand for loans, your business just dries up.
So this is what I want to ask Zach, because they've been through cycles they've been through bear markets before, but maybe not bear markets where a ton of customers pulled their money. Now, Zach said on the Brink podcast that he did say that 10% of customer deposits left and that it has slowed down. Who knows where it is? But I think from my understanding as an outsider looking in, what happened was the Terra Luna, or the Terra unpegging, caused a blow up. And 3 Arrows Capital, which was borrowing from everyone, they all had the same exposure. And so it was just a domino cascading it. So FTX is also giving money to Voyager, I believe. Celsius, you still haven't gotten clarity on what they're doing. They froze customer withdrawals. I still haven't heard any news on that. So if FTX ends up buying BlockFi for pennies on the dollar, that would be something. BlockFi raised $1 billion from investors. Total.
And that could be wiped out.
That could be wiped out in its entirety, which is pretty mind-boggling.
That's a lot. It just seems like I don't know how you could ever put a number on it. How much of that run up to 65,000 in Bitcoin was leverage caused? Because I mean, 2 trillion or whatever has come out of the system.
I don't know, 90%. Who knows? Anyway, I am we're very excited to have Zach on to hear his side of the story, and because listen, a lot of this is speculation. We don't know what's real, but there certainly is a lot of smoke, to say the least.
But do you think coming out of this, if crypto is going to move forward, there have to be greater caps on this leverage stuff like that?
I think so.
That seems like the thing that cascaded everything. It's like leverage going in and leverage coming out just makes the pendulum swing so much further than any other market, and there have to be some sort of caps on that to safeguard.
As we speak, with the equity markets puking strong. The Nasdaq 100 is down 2.5. S&P is down 1.5. ETH and Bitcoin are barely down. So maybe the worst of the runs are behind us. We'll see. But you can't play a counterfactual. But remember, like a couple of months ago, we were actually both surprised how well Bitcoin and crypto in general was holding up, given the nuclear destruction that was going on in all the other high beta names. I think that, and I was talking to my friend about this, so this is not like a unique insight, that all of the destruction and the puking in crypto that we've seen over the past few weeks has not been a macro shock with inflation and interest rates. It's just total deleveraging. And so it's kind of a shame that we really never got to see, was Bitcoin an inflation hedge, right? Because I don't think it's getting nuked because of inflation or anything. I think it's getting nuked because of leverage coming out of the system.
Yes, and tech people getting crunched on their growth stocks and their startups and everything.
Yeah, so I'm not saying that Bitcoin would have mooned because of inflation, absent the Terra depegging. But I'm also saying no, I'm just kidding. I don't know. We don't know.
Yeah, but my whole thing is just that there was way, way, way too much leverage. And I guess the whole point of the blockchain was the blockchain is there so you can see how much leverage in the system. And I guess with all these different moving parts and pieces, obviously that was not necessarily the case.
Actually,
and it's harder to follow than you think.
So apparently everyone's saying that DeFi is running totally well because DeFi is truly, truly, truly open source. Everything is on chain.
Right.
It's ironic that the centralized places are the ones that are blowing up. And Weisenthal was tweeting about this. If Voyager, BlockFi, and Celsius do disappear, and again, right now, I'm not saying BlockFi is going to disappear. We don't know. Where is the lending going to come from?
Yeah, maybe it'll move to DeFi. So I don't know. That's a good question. Maybe the lending just goes way, way down for a while because you've had essentially a run on the bank.
Ben, the other day I was walking, and I think you were on the phone with me. Somebody like screamed my name, and I turned around, and they're like, it was like high school kids. They're like, oh, so never mind. They thought I was their gym coach.
Remember, we went to a comedy show a few years ago, and some guy said you look like a JV wrestling coach.
Right, that's why I brought it up. All right, Ben, I've got a theory. You like to brag.
Okay.
You like to brag about how you just call up your cable provider and get your.
It's not a brag. It's just I'm trying to give people the information they need to lower their bills.
Okay.
Fight inflation.
Here's the deal. I tried it, and I tried.
Remember, we don't brag about money.
I tried it pretty aggressively. And I got...
Who's your provider?
Verizon. I got shut down hard. Here's my theory.
Okay, so what's your theory?
People in the Northeast are assholes, and 90% of Northeasterners call Verizon every time their bill is renewed to try to negotiate.
Yeah, you're more willing to have conflict.
Whereas people in the Midwest are generally nice. And so you are an outlier in the Midwest. You actually try and call and negotiate. And so they...
So here's my theory. So we have two different...
I literally said, I'm out. I'm going to cancel. And the woman said, okay, Michael.
So we have Comcast and AT&T here. And I use AT&T. And I think AT&T a number of years ago got me to leave Comcast because they said, we're going to give you this great deal. We'll save you $100 a month from Comcast. So I moved it over. And then every 12 months, my bill goes back up to the previous rate because the teaser rate came off. And so I call them and I say, hey, my bill just went up $50 a month. Can I take it back down? Otherwise, I'm going to leave and cut the cable. And they go, all right, hang on. Let's transfer you to the retention department. And then they give me $30 to $50 off. It happens every single year. So my bill just essentially stays the same. But my parents live in a city where they only have one provider, it's Spectrum. And so they have no negotiating power because there's no other alternative. I think there's a Tina element in here. There is no alternative. So I think the fact that I have an alternative, that helps. Maybe AT&T is just easier to negotiate with. But yes, I'm sure you're right. People in New York probably...
It's a geography thing. It's a geography thing. All right, let's move on to recommendations. We're running late.
Okay. We watched The Staircase over the last week on HBO Max.
Did you watch the Did you watch the documentary on Netflix a couple of years ago?
I did not. I heard about it, but it's like 11 episodes, so that's way too long.
Yeah.
I need like 90 minutes for a documentary. Yeah. Sorry, I'm not going to watch 11 episodes on it. But it's just we didn't know anything about the story going into it, and my wife and I both said, all right, we're not going to read anything until after the fact. Let's go in blind. It's just a crazy story. The hard part about watching it is there's literally zero characters that you like. All the characters are easy to hate. That's a hard part to watch. Here's my one finance lesson. It's a crazy story about a guy who potentially murders his wife, but there's all these different explanations for it. One of the things, took place in 2001. She worked for Nortel Networks.
Oh, he did. He did it.
Did it go out?
He did it, right?
Oh, he definitely did it. 98% for sure he did it. He's a creepy dude. She worked for Nortel Networks, had her whole retirement in Nortel Network stock, and the stock was dropping like crazy. Like it was down every time she looked, it was down like 20% in a day from the tech bust. And the big thing is diversification. That's the lesson from The Staircase. Besides, don't hit your wife in the back of the head and push it on the stairs.
Because it caused financial strain in the relationship?
That was part of it, yes. They were broke. Right. Okay, so you told me to watch The Old Man on Hulu/FX. I watched the first 10 minutes and I go, why does this story seem so familiar to me? It's based on a book by Thomas Perry. I read the book 2 months ago.
Not to brag.
Someone who's an animal spirits watcher gives me. I get book recommendations a lot because I talk about wanting to read fiction. And someone said, "Read The Old Man. You'll be hooked immediately." And I was. And I have to say,
show's pretty good.
There are some differences between the book and the show. The show is better than the book is good. The show is better than the book.
Oh, really? Let me ask. Let me take a guess. Are the dogs in the book? I bet the dogs aren't in the book.
They are in the book. That's how I knew it. I'm like, I've heard these dog names before, but the John Lithgow character was not in the book. Adding that gave it a totally different feel, and it made a lot more sense.
That's you know what I love to say. Remember in Severance how you saw John Turturro and Christopher Walken in scenes together. And I thought like, that's interesting. Two legendary actors. I don't think I've ever seen them on screen together. Seeing Lithgow and Jeff Bridges on screen together, even though they're not physically together, I'm all in on that. Anyway, it's a good show, right?
By the way, Jeff Bridges.
Best.
All-time hair. That guy's hair is amazing.
Ridiculous.
Guy's got awesome head of hair. All right.
But wait, what's your verdict? Did you watch all 3 episodes yet?
Oh yeah, we're 2 episodes in, and I think it's great. And again, I think I liked the book. The book was a little over the top. The show is even better than the book so far. Are you watching Shaun of the Dead for the first time in a while? Remember the big zombie trend we had for a while?
I never saw that. Never saw Zombieland.
Oh, okay. Shaun of the Dead is a great take on the zombie movie genre. It's hilarious. Yes, it's also really well, and there's a few serious parts to it. I think it's really, really well done. One more thing, I can't remember what I was watching, but I think especially comedies, movies that have...
I have seen Shaun of the Dead. I confirm, good movie.
It's very good. Movies that have like an extra scene or an outtake or here's what happened to these characters at the end, that's 15% better of a movie for me.
Great call.
I don't want the comedy to just end. I want the extras. While the credits are rolling on the side, I want to see one more scene or something else.
You know where that didn't work for me? Anchorman. Like the Brick character went to work for the Bush administration. That wasn't funny.
Oh yeah. Okay, yeah, you're right. Okay, that's all I got.
All right, The Boys season 3. I was sort of out. Like, I feel like they squeezed all the juice out of it. I don't really know what's going on. Not really paying attention. The last episode brought me all the way back in, and Homelander should win an Emmy.
Okay, that guy, he's pretty scary. We never made it past the first season for some reason because, like you said, it kind of just it didn't like draw me back in, but I did like the first season.
Okay. All right. So I went to the movie theater on Friday night, and I gotta say, I was a little bit anxious because there was a lot of people there. I don't like being big crowds of people, but I was also thrilled because there was a lot of people there. Movies are back. You had Buzz Lightyear that was out, Jurassic Park still in theater, even though it sucked, Top Gun, and I went to go see The Black Phone. Why? It's a Blumhouse movie. I like horror. Ethan Hawke, who doesn't...
Oh, it's a horror movie. You said you went to see this movie. You told me, and I'd never heard of it before.
Who doesn't love Ethan Hawke? And it got good reviews on Rotten Tomatoes. And guess what? Yeah, it stunk. Kind of stunk.
Oh, really?
Kind of stunk.
You've had some bad reviews lately.
Well, Jurassic Park really stunk, and this didn't stink. It was like a 6.3. It wasn't. I believe you me. I've seen worse. All right.
Okay.
Financial advisors, come join us. We spoke about this last week. We want to hear from you. If you are, I don't want disgruntled employees. I want people that wouldn't.
We want people who are gruntled.
No, here's what I want. Listen, I'm actually happy where I am, but I want to work with you guys. That's who we want. I don't want disgruntled employees. If you're looking for a change of scenery, camaraderie, technology, teamwork, let us know.
Here's the big sale. If you just want to be an advisor and don't want to do operations, you don't want to do marketing, you don't want to do sales, you don't want to do prospecting,
yes.
we handle all of that for you.
info@ritholtzwealth.com. All right. And you want to email us, we're animalspiritspod@gmail.com. Thank you for listening. We'll see you next time.